Good afternoon. I'm Will Mateo, the Membership Experience Manager at the Australian Investment Council. Thank you for joining us today on this webinar on the currency overlay. Today, we're joined by Thomas Averill, who is the Managing Director and Co-founder of Rochford Capital, Eric Siegloff, who is the Chief Investment Officer at Alpha Vista. They will deliver a practical insight into currency overlay and the minimization of FX exposure as it relates to your portfolio transactions. They'll be giving us a few examples on the utilization of big data and AI across the investment life cycle and operations, including risk diversification and the benefits of currency exposure and the potential to reduce overall volatilities in the returns. Now, a few housekeeping points. Your mics are on mute and your videos are off. However, if you do have any questions, please feel free to use the chat box, which I'm sure everyone now may have experienced Zoom on a number of different occasions. So I ask that you then send through your questions via the chat box, and we'll ensure to ask the panel those questions that you may have. Over to you, Thomas and Eric. Thank you very much again for supporting us and providing us with your insights on currency overlay and the use of big data and AI in the investment process. Over to you.
Thanks, Will, and thanks again for the opportunity to present to the AIC membership base. I hope everybody finds this presentation interesting, and I think that both Rochford and Alpha Vista and Eric and I are trying to show this as a way to view the currency risk of your investment portfolio from a slightly different perspective than you traditionally would have done. But firstly, just quick background on Rochford and Alpha Vista. Rochford is a financial risk management firm. We manage risk on over $20 billion worth of financial risk, whether that be currency, interest rates, and commodity risk annually. We have recently joined forces with Alpha Vista primarily to disrupt the currency overlay strategy or currency overlay industry, where traditional managers of risk really don't think are achieving the objectives of asset managers and not harnessing the power of big data and artificial intelligence. And Rochford has been looking in the market for someone to work with there, and Alpha Vista is our chosen partner in sort of revolutionizing the way asset managers look at currency risk, and particularly its impact on overall volatility and returns within their portfolio. So I'm going to start off with just giving you a bit of context around what traditional currency overlay strategies are and the different objectives for them, and then talk a little bit around the sort of pros and cons with them and how they interact in different underlying market dynamics and work effectively or not. Now, typically, fund managers will deploy one of three principal methods of managing currency risk within their portfolio. One being passive risk management. So this is typically when you're trying to strip out the currency impact on portfolio returns. Now, you'll see this often in asset portfolios that are more around income yield than they are around absolute return. So within fixed income and real estate funds, where you're looking to get a yield, obviously there isn't much tolerance typically within yield these days to deal with currency risk. So you're often seeing this is where passive currency risk management is deployed, where you're just rebalancing your currency hedges to the income and asset base periodically to match that. And I'll talk about some of the challenges with currency or passive currency overlay as we go through the presentation, because I think for us, that's one that's really, really ripe for improvement, and where there is a lot of low-hanging fruit for asset managers to improve outcomes by changing their perspective when it comes to passive currency risk management. Active is when you're using the currency exposure of the asset base of the investments to try and generate additional alpha, additional return. And then lastly, dynamic is a bit of a hybrid of the two and has quite a bit of latitude between them. And dynamic is usually typically when risk management is your core objective, that you're not looking to necessarily add return, but you're cognizant of the potentially dilutive impacts of passive risk management in terms of drawdowns to fund mark-to-markets, warehousing credit, and collateral to fund currency overlay strategies. So you might choose a more dynamic application of the strategy to mitigate some of the traditional challenges. You find that most managers will use passive, few will use dynamic, and very few use active currency overlay strategies here to generate alpha. Active was a much bigger trend back in the 2007 and 2008 before the GFC, back when you did have yield on currency, and the carry trade was something that existed, and you had big hedge funds like FX Concepts, for example, that produced stellar returns. In the absence of interest rate differential and the kind of relatively lower risk profile that provided, straight directional alpha in currency trading is less usually deployed. But I think what Eric will move on to later in the presentation is actually how you can use the power of AI and big data to generate alpha out of currency direction, as opposed to out of yield. I think, you know, the yield differential days are certainly behind us for a while. So moving on to the key challenges with traditional methods of managing currency overlay, and one of the biggest ones is liquidity mismatches and drawdowns. And I'm actually going to advance to the next slide and then come back here. Now, the issue being, particularly with managers that are looking at Aussie dollar denominated portfolios and say US dollar denominated assets, because of the Australian dollar's position as a sort of barometer for global risk, you will see big sell-offs in Aussie is the same time as you see, for example, big sell-offs in equity markets. So when you're seeing your underlying asset portfolio perform badly, you're seeing significant mark-to-market losses on your currency overlay management strategy, particularly with the passive management, which in March 2020, at the highlight of COVID, you saw many managers suffer from that. And depending on how much capital they've warehoused to fund their overlay strategy, or what their credit arrangements may be with their counterparty banks, lots of asset managers were having to find huge amounts of capital back in March 2021 to fund mark-to-markets and to fund hedge rolls. Now, the issue with that is if you're not carrying sufficient cash, you've also got to sell assets at the worst possible time to fund hedge mark-to-markets. And then equally, what often happens here is, you know, if you're getting a V-shaped recovery in asset markets, you get a V-shaped recovery in the Aussie dollar as well. So often you might see a fund manager completely switch off their risk management here to deal with a liquidity impact, and then run unhedged in a recovery of the Aussie, and then have a negative impact of returns thereafter. So I'll come back to that slide in a second, but it's just that chart that really illustrates how, when you've got passive hedging on offshore assets, you know, it can really have a negative impact on overall returns. Equally, if you're unhedged here, this shows the impact of how an unhedged exposure can provide good portfolio diversification when you're seeing big sell-offs in your underlying assets. What I also mean here in liquidity mismatches and maturity investment horizons, the key thing here is very rarely will you get, unless you're looking at a big infrastructure project or a rock solid balance sheet, will you get hedging lines from your banking counterparty that match your investment time horizon. So, for example, you know, you make an investment in Facebook that you want to hold for the next 3 or 4 years. Your bank's not going to write you a 3 or 4 year hedge that you've got to come back in 3 or 4 years and settle. They might give you a rolling 3-month or a rolling 12-month hedge that you've then got. So you've got a cash derivative realized exposure against an unrealized exposure on the underlying investment. That creates big challenges from a liquidity standpoint. Also, if you don't get the accounting treatment right, that can create issues from a tax standpoint as well that you need to manage in terms of having unrealized gains or losses on an underlying versus realized gains or losses on an overlay strategy. So that covers off sort of the first two major challenges. Three is if you want to try and address one or two, but still operate a kind of passive overlay strategy, you're going to need a banking counterparty that is willing to provide you significant amounts of credit. Some funds have the luxury of being able to get that often in the mid-market, and it also depends on how you have custody of assets. For example, if you're a feeder fund, the credit becomes much more difficult, or the underlying assets within your portfolio are less liquid. Again, these sorts of things can become much more difficult. And interestingly, with passive overlay, typical instigators of that are trying, the objective of that is to reduce volatility in returns, or hedging in general should reach out to reduce volatility in returns. If you do big binary one-off hedges, that only really increases volatility in returns, or at best keeps them neutral. And the math of it is not really complicated. If you're doing it frequently and often, then the benefit of averaging is really how you reduce volatility in returns, as opposed to having one massive hedge that's either significantly in the money or out of the money. Again, if you particularly, and this is particularly for Aussie denominated managers, if you've got long Aussie hedges in place, then you've got a significant reduction in risk diversification. Having said that, if you see big equity bull markets, like potentially like the one that we're in at the moment, or the one that we saw post GFC, often that is highly correlated to a recovery in the Aussie. So if you don't have hedges in place, you can have quite a big dilutive impact on returns, and that correlation is broken down since we've had this sort of a new Delta variant here, but over time it comes back into place. So ultimately what you want to achieve, and the presentation will go into more detail, is actually, the best overlay strategies are ones that are dynamic, that you have the hedges in place when you need them and not in place when you don't. But then how do you do that decisioning? How do you make that decision? And Eric, as we move on, will talk to that with how we can leverage technology to help you achieve that. And then point five is, if you've got a warehouse, if you look at value at risk on a 12-month basis in Aussie US, and you're using that as a potential credit drawdown on a hedging strategy, you might be warehousing somewhere between 10 and 20% of your investable capital to fund the credit exposure or drawdown exposure of a big mark-to-market move. So that's really, really dilutive on returns, because you can't get a return on that cash, or you can, but it's cash-like instruments is obviously not going to give you the kind of level of return that you would get from your underlying assets. So that can put you well behind your peer group and make your fund less attractive to investors. And then 6, poor mandate construction implementation. I think here is what often isn't done enough in terms of understanding how currency plays into the performance of the underlying assets. So what correlations will you have? How an effective risk diversificator is the currency risk within the portfolio? So understanding, backtesting asset behavior to currency moves, and then right-sizing your mandate and your objectives to align to that, as opposed to just a binary, again, 100% passive hedging. Eric's got a really interesting a bit of analysis that goes back sort of 30 years. And actually, if you do passively hedge over the long term, you kind of end up in the same outcome as if you hadn't hedged in the first place. So if you're really, trying to take volatility out of returns or get a better outcome, it's not really helping you achieve that over a long term. And then finally, factors are not consistent, but correlations are unstable, right? Correlations are moving all the time. So, 2021 is a great example of that. For the first half of this year, Aussie was relatively positively correlated to equity markets. In the last 2 or 3 months, Aussie's been going down and equity markets has been going back up. So correlations are only as good as they are that day. The trader's mentality is only as good as your last trade. So if you are adjusting something that is dynamic in nature, then or on a rules-based system, you have to have something that is changing to the underlying market conditions. Now, the reality of that is it's quite hard for a human to ingest the amount of data that's required to then automatically adjust or rebalance your hedging strategy to reflect changing market conditions. And again, as we move through this, Eric will talk to that and how we use AI and big data to affect that. So again, I've talked about this slide as we talked about the challenges in the previous one, but the core component is if you could have your cake and eat it with risk management, then this move from March, in March 2020, you want to be unhedged, and for the subsequent rally, you want to be hedged. Now, this is not necessarily about the way to do it is not, everyone knows you can't long-term predict currency markets, but you can have a risk management strategy that is dynamic enough to adjust to market conditions that you benefit from the risk diversification of currency risk, from the fact that the US dollar is still the risk-off place where everyone goes because you have to settle for US dollars if you're liquidating assets throughout the financial system, but then also take on hedges to protect you from Aussie appreciation in general sort of risk on views. So it's Rochford's view, more dynamic approaches, more proactive approach to risk management allow investment managers to achieve significantly better outcomes for their investors over time, which is why that we've been looking for the right partners in let's say, within the technology, fintech, big data, big AI space. So without further ado, I'll hand over to Eric now, who will go into more detail around how you can use the power of technology to sort of change the landscape and change your perspective when it comes to currency risk management.
Okay, thanks, Tom. And thanks, Will, for the introduction. From our various institutional engagements, clearly the challenges that Tom has highlighted are common. And we know that currencies can do little for a while, and then when they move, they really move. And to Tom's point, we also know that passive hedging isn't really effective during tail events. And Tom mentioned COVID, GFC, .com, any range of all those. If you can click to the next slide. So what are the key objectives? What are we looking to do in terms of adding value to the FX solution? Well, first of all is to deliver alpha over and above the core portfolio. Second of all, we want to account for market stress, and particularly during tail events, which over a continuum of time adds value in a compounding manner. From that, obviously reducing drawdown. And we want to demonstrate that we can improve risk diversification and also improve the risk reward. And doing that without diluting the underlying returns and without compromising any fund liquidity, as Tom has highlighted. So what's the ideal outcome? From our perspective, it's a real-time signal in FX markets that informs whether or not we should hedge. It's quite simple. And the question is, how do we solve for these challenges? If you go to the next page, Tom. We're using advanced non-statistical maths to identify a pattern. That's the first thing. And then from that pattern, we're seeking to understand the state of a regime that pattern can be in. And simply, it'll be regime change or regime reinforcement or regime perturbation. And over the time, our research has indicated and recognized the importance of human biases and market psychology in this. So we brought this through reflexivity, in other words, feedback loops, into analysis. So when we do our analysis over time, we're not only doing the pattern recognition and the signaling and the decision-making that comes from that, but also it's incorporating these feedback loops as we go through time. The key thing here is to ensure the effectiveness and the quality of the signal. And in doing that, we carry out the analysis in real time. One way to think about what we're doing is we're focused on simply the formation and dissipation of risk through time. in a real-time manner. And we do this ex ante rather than ex post. We don't look back. It's live streamed, and we do it on the run. And importantly, in doing this, we don't do any forecasting. We don't focus on any prediction, and we don't focus on any optimization as well. So our approach is non-statistical in its nature. It uses data, it uses pattern, it extrapolates from that through the algebra, etc., and the application of AI. But we don't actually do let's say, the smoothing of the data or the manipulating of the data that some people may do. We just look at the purity of the data and extract from that. So the objective for us in terms of big data computation is to develop information-rich signals. If you can go to the next slide as well. Is to develop information-rich signals, and this enables us to have high conviction in our signaling and also decision-making. And to do this, we're finding information in every tick of data. In the case of FX, this is at the millisecond level. And today, just for context, we've got the capacity in terms of scalability and platform to ingest 1 million ticks per second per currency pair. So in the case here, we're talking about the Aussie dollar, US dollar example case study, which we'll come to later. That's 1 million ticks per Aussie US in time. And to ensure that we have a high quality regime analysis, what we're focusing on here is the need to absorb all historical data. So we always go for the longest data set. In the case of foreign exchange, for us, the data set starts in February 1996, so 25 years worth of data. And the importance of that is we get that tick time frame from February 1996 to now. And that's the means by which we can then go to one further point, which is when we do the analysis. Right now, we've now analyzed 3.5 billion ticks per currency pair. And this is growing daily at a rate of a couple of 100,000. So what we're seeing here is the data then, it gives us the information-rich signaling, which when we combine with the AI, Tom, if you can turn to the next page, allows us to deliver those objectives that we talked about further. Higher alpha, lower drawdowns, better risk diversification, and also improved risk reward. If you can go to the next slide, Tom, what we'd like to do is turn to a simple case study and compare some outcomes. And we're comparing outcomes between a traditional passive hedge and let's call it a big data AI active hedge. And simply what we're doing here is we're choosing a base portfolio, in this case, S&P 500, investment into that index from an Australian perspective, so it's unhedged. And then we look at that portfolio with a 50% passive hedge, i.e. the hedge is on all the time. And then we compare that against the active hedge, obviously variable. And here we're using our signaling to indicate whether on a daily basis, we put the hedge on at 50% or take the hedge off. It's as simple as that. It's an on-off binary, very, very simple case study. So on the first point, in terms of generating alpha, again, we mentioned 25 years worth of data. This is a very simplistic chart. It basically shows compounding more than anything else. But what we observe here is that the passive hedge, which is the red line, and the core portfolio, the S&P 500 unhedged portfolio, basically track almost the same. And to Tom's point, which he mentioned earlier, the gains from hedging over time become zero sum in this particular example. What we find, therefore, is the passive hedge did not meaningfully add to the core portfolio, and we see that the active hedge delivered through the period. Notably, in delivering that, slightly less volatility than the core portfolio at the time. So what we see from this is, in this case example, a significant alpha generation coming from the platform. If you go to the next slide, Tom, in terms of drawdown, I think it's important that we see visibly here, the green line being the active hedge, the red line being the passive hedge, and the dotted blue line being the core portfolio. So you can see clearly here that there's a lower drawdown from the active hedge. There's certainly faster recovery from the active hedge as well. But Tom also mentioned this during tail events when the S&P 500 is falling. In this example, the active hedge is typically off, i.e. 0% unhedged. And hence, during these periods, there are no margin calls. And this is in contrast to a passive hedge, which is maintained at a 50% throughout level. And clearly, you get a liquidity enhancement on the back of that. You go to the next slide, Tom. So in terms of risk diversification, we clearly need to look to improving that. We've undertaken quite some analysis into the formation and dissipation of risk through bull and bear markets going back since our start point of 1996. So we've looked at the dot-com bust as an example. We looked at GFC, COVID, and obviously some risk events in between all that. And here what we're doing is just showing some analysis where we look at the period leading up to the COVID-19 collapse of February 20, which is a cumulative feature of how the passive overlay worked against the core portfolio, and then we compare it to the COVID period, which let's call it the tail event or the bear market. If you can focus on the top left-hand chart and the bottom left-hand chart, what you see here is the difference between the underlying portfolio with a passive overlay above and with an active overlay below. And the most obvious thing you can see, because the scales are the same, is that the tails, left and right tails of this set are substantially reduced in the bottom, i.e. the active overlay. What you can also see is that there's a flatter surface. So in other words, there's a spreading out, let's say, of the return distributions on the bottom slide versus the top one. So what this means is we're getting better risk diversification through the bull market. It also, I think you can highlight, if you have a look at some of those numbers there, there's some correlation numbers printed in there as well. The correlation between the core portfolio and the portfolio with a passive hedge is 0.9. Down below, the correlation between the S&P 500 unhedged and the active is 0.45. So in the process of applying the active overlay through this bull market, trough to peak, we basically halved the correlation through that period by applying the active overlay. If you then look at the right-hand chart, so now we compare the right-hand top chart to the bottom. This is the COVID period. This is the February to March. The dates are specified within there. And again, what you can see is the surface and the active overlay below. Even though it's a short period, you can see the surface is spread out more, which basically highlights better risk diversification. And importantly, you can see the correlation on that period, on that collapse period, was 0.99 between the S&P 500 and the S&P 500 with a passive overlay. Whereas when you compare that with the active overlay, it's 0.09. So it's not quite orthogonal, which would be 0, but certainly much less correlated than what you saw in the application of a passive overlay. And finally, Tom, just to the next page. In terms of the risk reward, just one page further, Tom, if you can do that. Yeah, so what we see here is the green line is the active hedge. Again, the red is the passive hedge, and the dotted line is the unhedged. I haven't put any numbers up here, but visibly you can see that there are better outcomes coming out of the green line, the active hedge. You saw from earlier this higher alpha. Obviously that leads to higher returns because it sits on top of the underlying portfolio. And I already mentioned that we're getting slightly lower volatility. So clearly from that, the active hedge provides better volatility adjusted returns. And just for context, over that whole period, 1996 to now, the core portfolio, the S&P 500 unhedged, delivered a 10% per annum return. the 50% passive hedge delivered almost to the first decimal point, a 10% return, while the active hedge delivered just under a 15% return. So when you saw that first chart, clearly that's just the effect of compounding coming through. So look, I'll leave it there. In summary, what I'm trying to highlight here is that we see AI and big data as a clear advantage in terms of trying to deal with common problems in currency hedging, and certainly the applications of solutions to currency hedging. And I'll just echo what Tom said. We're very pleased to be working with Rochford to bring this to the market.
Yeah, thanks, Eric. Are there any questions at all from anybody within the audience? Please feel free to quickly jump on the chat box before we wrap this up. But I think what we're Eric and I and Rochford and Alpha Vista are trying to sort of educate the investment community is that you can be inclusive in how you view currency within your overall investment portfolio, and actually use that to drive alpha and volatility outcomes, which Eric highlighted the compounding impact that has over a long-term investment cycle that can really add some great additional performance to your portfolio. Now we've highlighted examples there with the S&P 500, but we've also back-tested this across real estate portfolios, credit portfolios. So it really doesn't, it's obviously going to change dynamic depending on what the underlying asset base is. But, I remember going to watch a presentation on currency overlay by one of the biggest overlay managers in the world. And their idea of dynamic overlay was changing their hedge balancing when purchasing power parity went 20% over or undervalued, which, I think if you're that reactive to market conditions, your ability to add alpha or any other key performance metric is pretty limited. And I think because there hasn't been these kind of solutions available before, the investment market is sort of preconditioned to never getting currency right, for example, or operating philosophy that it will all even out in the end. So we're here to change that narrative and work with managers so they can actually use the currency exposure of their assets to improve their fund performance. But I don't think, unless Will tells me any different, that we've got any
Hi,
questions.
how you going? Yeah, no other questions that have come through. I think that that was a really clear explanation. Oh, wait. Hold on one second. We've just had another question come in. Apologies for that. Hi, Eric. Has this analysis been applied?
Okay, so what we've shown is a case example here, Will, and it is not live in the sense of running a portfolio at this time. We've done extensive analysis with particularly a couple, but more super funds on FX over the last 2 years. So we've been able to hone this quite well. We have, in fact, this month already launched, where we're launching three funds on a separate tack related to currency, but this is not to do with currency hedging. So in terms of the actual application, as opposed to the work that we've done on it, no. But that's why we're with Tom, and we're looking forward to meaningful sort of work in this area with Tom and Rochford. Yeah,
so Joanne, on that, this is the information that we presented today is obviously on backdated or back-tested data. Unfortunately, Alpha Vista, I think, launched this product back in, you've been going since 2016, but it has been sort of vigorously tested, and we are in the process of applying it to some various asset managers at the moment.
Excellent, thank you. And so another question on your analysis: have you adjusted the cost of hedging with forwards, and if so, by how many points?
Not in this analysis. This is very rudimentary. It's gross returns, and clearly initial and variation margins will need to be added to that, and therefore you can clearly that will come off those numbers we talked about.
But also to add to that, the way that the technology works and the solution works is because you're not looking at long dated passive hedging where you're going to have to pay a lot for the credit and potentially interest differential forward points. This is the best way to think about it. It's a light switch, right? You turn the light switch on when you need it, you turn it off when you don't. Yeah. So as a consequence of that, the average duration hedge profile is much, much shorter. So that's less credit intensive because you're not carrying the hedges for as long, and you're not paying interest rate differential. So, we're effectively trying to reduce the volatility in the normal distribution curve and then skew it to your favor. So the underlying transactional costs of hedging should be less, although you'd be more frequent. So you're crossing the bid and offer more frequently. But we've negotiated with our counterparties and our solutions to make sure that execution is efficient. So we don't think that execution costs would have a material delta on the analysis presented.
And can this analysis be applied to the private equity portfolios where the underlying data isn't as timely?
Well, that's a really interesting question, because Rochford as a business works a lot with private equity, and depending on the underlying assets and where the manager is based and the view of their LPs, typically they don't run hedging strategies across an investment life cycle, but because they don't want to draw down investor funds to fund mark to markets, but they may well look at it when they've got an exit on the horizon. So yes, this can be done with private equity portfolios, because this type of risk management strategy is much less credit intensive than a traditional, we've got an asset value of 500 million, let's go and stick a $500 million hedge on to sell this asset in 4 or 5 years' time. So yes, it can be, is the answer, and arguably it's better suited than traditional methods of hedging. And happy to have a further follow-up call if anyone wants to discuss that in more detail.
Yeah, on the data side, clearly we've given this example in tick time frame, where we can deal with multiple time frames as well. We just need to have enough data to ensure that we can actually get pattern and regime, and then from that determine signal. That'll be a case-by-case basis, and we'll just apply it on the case put in front of us.
Excellent. So no other questions, at least at this point in time.
And then I think will be sharing this presentation with everybody on the group today. So if anybody's got any follow-up questions, feel free to reach out either to me or Eric directly. Understanding this is kind of a new perspective for someone on the call, so you're more than happy to have any follow-up chats that would be useful.
Yeah, that's right. So we will, as you may be aware from the start of the presentation, that this has been recorded, and if you could kindly give us your feedback, we'll be sending out a survey, and at the end of the survey there'll be the access to the presentation as well as the video recording. So that we would appreciate any feedback that you can provide us. And of course, if you have any follow-up questions that may come to mind a little bit later, then please feel free to reach out to Thomas or Eric, or if you would like to send us at the AIC a message, then we can forward it on to them if you don't have their details. But their details are right in front of you in this last screenshot. Again, I want to thank you, Tom and Eric. We really appreciate those insights, and also we hope that everyone that's joined us today gained some insight and value and valued the insights from the presentation by Tom and Eric on currency overlay and the use of big data and AI during this private capital knowledge series. Another quick point, you would have received all by now that we have rescheduled the annual conference to next year. The conference next year will be held on the 16th and 17th of February. So you would have received a few email notifications around that a few weeks ago. But if you haven't, just giving you an update now. Obviously, over the course of the next couple of months, we'll continue to update you on speakers and the program itself. But we really appreciate your time today, and we look forward to having you at future AIC Council events. Have a great remainder of the day, and thank you all again.
Thanks a lot, guys. Have a lovely afternoon.
Thanks, Will. Thanks, everyone.
Thank you.